You know the pitch. It's the absolute classic sales pitch of the financial world.
Oh, yeah.
If you have a bank account or a retirement plan, you've heard it. It's always some version of the market is dangerous.
A volatile beast.
Exactly. And sure, when things are good, a rising tide lifts all boats, right? Anyone can make money.
Mm-hmm.
But when the storm hits, when the world goes, completely crazy, that's when you need a professional, a captain at the
The
wheel.
captain of the ship theory. It's a very comforting story.
It is the idea that a smart human, an active fund manager can see the chaos coming and navigate it better than some dumb computer program that just tracks an
A
index.
program that just goes down with the ship,
Well,
supposedly.
right. It's the premium service argument. You pay more, sometimes a lot more, to protect your money when the sky is falling. But here's the question for our deep dive today. Is any of that actually true?
A big question.
Yeah, because the world really did go crazy recently. We had a global pandemic, a major war in Europe.
Hmm.
Did those expensive experts actually earn their keep?
Or would you have been better off uh, just trusting the mindless algorithm?
That's it. And to answer that, we're not just going on feelings, we're looking at a fascinating piece of research.
Right. This is a 2025 master's thesis from the University of Vasa by Carolus Freelander.
And the title is The Performance Comparison of Active and Passive Funds During Financial Turmoil. The timing on this data is, this just impeccable. It goes right into the fire.
It really does. Freilander analyzes a massive 10-year period from late 2014 to late 2024.
10 years.
And it's not just one market. He looks at 54 specific funds across three totally different arenas. North America, so the S&P 500,
Okay.
Europe, tracking the MSCI Europe Index, and then a much smaller market, Finland, looking at the OMX Helsinki.
So, our mission today is to try and settle this active versus passive debate, but specifically through the lens of all this recent chaos. Before we get to the results, though, let's just quickly define our terms,
Yeah, good idea. So passive management is all about the efficient market hypothesis.
which basically says you can't beat the market.
Pretty much. The theory is that all known information is already baked into the stock price, like instantly. So don't even try to outsmart it. Just buy the whole haystack, the whole index, keep your costs as low as possible, and you'll do fine.
And active management is the opposite. It assumes the market is messy, emotional.
Exactly. Active managers believe there are inefficiencies, that the market overreacts to bad news or ignores good news.
Yeah.
They have analysts, they study balance sheets, and they try to pick the winners and avoid the losers.
And you would think that skill would be most valuable during turmoil, right? When everyone is panicking.
That is the core of their entire value proposition.
Yeah.
And this study defines that turmoil period really clearly.
Right. It isolates 2019 to 2024.
And think about what happened then. First, COVID hits in early 2020. That was what we call a symmetric shock.
Meaning it hit everyone, everywhere at the same time.
Correct. A global shutdown, universal panic.
Mm.
But then, just as we're recovering from that, we get the Russian invasion of Ukraine in 2022.
An asymmetric shock.
An asymmetric one. It created an energy crisis and massive instability, but it hammered European markets way harder than the US.
So, two totally different types of crisis to test these managers.
Exactly.
Okay, if I'm paying a manager 2% a year, this is their Super Bowl. This is their moment.
This is where they're supposed to shine.
So let's get into it, and let's start with the part that always hurts the most, the price tag.
The fees.
Yeah.
And they are starkly different. The study highlights passive funds like Nordea European Passive Fund 1 or OP America Index 2A.
And what are they charging?
Tiny amounts. We're talking ongoing charges as low as 0.28% or 0.4% a year. It's almost nothing.
Barely a blip. But then you look at the active funds.
A completely different world. You see funds like Actia Europe or Sasta Panki Kodima B. Now you're talking about annual charges getting close to 2%.
Wow.
And some of them have subscription charges, load fees of 1% just to get in the door.
So you start 1% in the hole and then pay 2% every single year. That manager has to be a genius just to get you back to even.
And this brings us to probably the most damning statistic in the whole study. Freelander ran a regression analysis on the North American data.
Okay, so that's a statistical model to see what's actually causing the difference in performance.
Exactly. What moves the needle? Is it the manager's skill? Their strategy? What is it?
And the answer was?
Costs.
Yeah.
Pure and simple. They found an R-squared value of 0.876.
Okay, unpack that number for us. In plain English, what does 0.876 mean?
It means that nearly 88% of the difference in returns between all those funds was explained purely by their fees.
88%.
It wasn't about the manager's brilliance or their market timing. It was almost entirely the fee structure. If you knew the fee, you could predict the performance with stunning accuracy.
So the fee isn't just a drag, it's basically the whole story.
And it gets even more specific. The model showed what you could call a burn rate. For every 1 percentage point you add in fees, the net return of the fund dropped by about 1.736 percentage points.
Wait, hang on, how does that math work? If I pay 1% more, shouldn't I just lose 1%? Why is it almost 1.8?
That's the insidious nature of fees. It's the destruction of compounding. You don't just lose the 1% fee today. You lose all the future growth the 1% would have earned forever. Over 10 years, that really starts to snowball. Or rather, it stops your snowball from growing.
So in North America, the S&P 500, how did the active managers actually do?
It was a blowout, a complete massacre. The S&P 500 benchmark returned 9.50% a year over the whole period.
And the active funds?
Not a single one beat it, not one.
Zero.
Zero. The best passive fund was just behind at 8.92%, just because of its tiny fee. The worst active fund, the OP America Value Companies, was down at 5.31%.
That's almost half the return. If you had your retirement in that fund, you have half the wealth of the person who just bought the index.
And here is the real kicker for North America.
There's more.
The study notes that the active funds lost to passive funds, even on gross returns.
So even before you take out the fees, they were doing worse.
Yes. Their stock picks were worse than the index, which suggests one of two things. Either they're just bad at their jobs,
Right.
or it suggests closet indexing. This is the dirty little secret where a manager is so afraid of underperforming that they just secretly buy the index stocks, Apple, Microsoft, whatever, but still charge you the high active fee.
So you get the index return minus a huge fee. You're guaranteed to lose.
Guaranteed.
Okay, so they didn't make us rich. But what about the other side of the sales pitch? The protection, the safe haven idea. When COVID hit, did they at least cushion the blow?
This, honestly, was the most counterintuitive part of the whole study.
Because you'd think a human could say, whoa, sell everything, go to cash. A computer doesn't do that.
Stop the bleeding. Right. But the data shows the exact opposite happened. When you compare the calm period of 2014 to 2019 with the turmoil period of 2019 to 2024, the active funds actually performed worse relative to passive funds during the chaos.
So when the storm hit, they didn't just fail to steer to safety, they actually steered into the rocks.
Essentially, yes. In Europe, for example. In the calm period, the active funds were kind of competitive. But during the turmoil, the gap widened significantly. The average net return difference jumped to over 3% in favor of passive.
That completely destroys the sales pitch. The turmoil is the one time you're supposed to be happy you're paying the fee.
It is. The theory is that managers can time the market. But the reality seems to be that in a crisis, doing something is often much worse than doing nothing.
Because they sell at the bottom and buy back in too late.
They get scared, they get greedy, and if you miss just a few of the best recovery days because you were sitting in cash, your long-term returns are just destroyed. The index fund just sat there, took the hit, and rode the whole wave back up.
Okay. So they didn't make more money, they didn't lose less money. But what about the ride itself? Did they at least smooth out the bumps, the sleep at night factor?
I have bad news for your sleep schedule. The active funds were consistently more volatile.
Of course they were.
The study points to one fund, the OK America Small Cap A. It had the highest volatility in the whole data set, 18.24%. It also had a beta of 1.27.
And beta is the sensitivity to the market.
Right. A beta of 1 means you move with the market.
Yeah.
A beta of 1.2 means you were 27% more volatile. So when the market drops 10%, you're dropping nearly 13%.
So you were paying a premium price for a much riskier, wilder ride.
But that's what the data says.
It feels like we're just piling on, but we have to talk about the risk-adjusted metrics, the bang for your buck.
The Sharpe and Trainer ratios, yeah. They basically ask, for every unit of risk you took, how much return did you get? The S&P 500 index itself had the best Sharpe ratio, 0.5976. The best active U.S. fund only got to 0.5111.
So the index is just a more efficient machine for generating returns.
Exactly. And then you have Jensen's Alpha. This is the one that's supposed to measure pure manager skill. It's the return you get above what you'd expect for the risk you took.
A positive alpha means you have a genius manager.
And a negative alpha means the manager is actually destroying value.
And what did the alpha say?
Almost universally negative.
Yeah.
Across the board, they were subtracting from the return you should have gotten.
The study even brings up Burt Malkiel's famous theory here.
It does. The dart-throwing chimp. The idea that a blindfolded chimp throwing darts at a stock page could do just as well as the experts.
And this